Welcome to this week's weekly market commentary, and I want to piggyback again off the topics last week on the topic of a recession, the inevitable recession, the earnings backdrop, the dismal components that are perceived to be dismal, I suppose. And it's interesting because this previous week we had a slew of tech earnings that came out, and we had some misses, some outpacing expectations, some neutrality. Yet, by the sheer nature of how big those companies are and how impactful the sentiment of that earnings backdrop is, their weighting in the S&P 500 did cause some marginal downside, and rightfully so. When you extrapolate it and look at all the other constituents, that wasn't necessarily the case across the spectrum. What all that's done really though is just continue the rhetoric of the potential recession, of the announcement of that recession. And as I mentioned last week, the likelihood of us entering one or being announced into one is very much prevalent. Yet that will be indicative of what has happened in the past. So under that assumption, and assuming that's the case, what we did, we ran some research, and actually we have ran this in the past and simply updated it and kind of reanalyzed the information. You're kind of looking at equity market returns during recessions and after recession ends on a 3 month and 24-month basis as a means of gauging equity market participation. So, Alicia, hello, welcome being here again.
Thank you.
Go ahead and walk us a little bit through the expectations from a historical standpoint. What happens to equity markets on that 3 and 12 month, 24-month rather, a time frame after the recessionary period is over?
So, what we looked at in this data is we looked at the MSCI World Equity Index and we ran the numbers on returns during recessions. And clearly, investors understand that during recessions, we typically do have market declines, and that is what has happened historically. But when we look further out, when we look 3 months out after the end of a recession, we can see that the returns are very positive in all
Mhm.
but one instance.
Yeah.
And when we look further out at 24 months, again, we are seeing very much positive returns other than one instance. So, what we can say is that equity market participation during a recession does make sense. And actually, adding to equity market participation makes a lot of sense given this data.
Yeah. What's funny is, we have numerous subset of clients that already are in that equity market participation bucket. Um, the adjustments there that we make, walk us through some adjustments that we make for somebody that is already invested in equities at a 80-90% threshold. What can we do within that subset to further enhance or reduce the volatility profile within that makeup?
So, at our last quarterly rebalance, we did a further overweight into the value sector. Growth sector is continuing to be beat up, just like the earnings announcements that we've seen with Alphabet and Microsoft, and the declines that we've seen just this past week from that. So, we're going into more value. We're staying up in large cap because that tends to have lower volatility. And then within those growth sectors and the small cap sectors, we're focusing on companies that do exhibit lower volatility. We're also overweighting domestic over international, given where we see markets and the outlook for the US versus international markets.
Yeah, and then we have employed some currency hedging as well in the international
Yes,
space.
yes.
All things that within the subset of a notably larger kind of makeup of household management on the investment side, we do take all that into consideration very, very closely. What I also want to touch on as a last point here today is in the recessionary data piece that we're going to release, you'll see that returns during the recession seem a lot more muted than what the volatility profile has been so far year to date. And I want to stress the fact that simply because we have seen a negative 20% threshold year to date, none of that means the markets are going to finish at that level. They certainly could, but none of it means they're going to finish at that level. And a secondary piece that we were updated that we're going to also release is kind of tracking our annual peak to trough declines in the within the markets relative to where they end the year. And what you'll find is that rarely do markets finish the year at the trough of that downside for the year. Okay. It's happened once or twice going back to at least the early 1990s. Um, we believe that to be the case this year as well, because the earnings backdrop from an expectation standpoint, although it has been depressed relative to previous quarters, those figures are coming out with a slightly better surprise to the sales growth and earnings and earnings standpoint. I covered this last week a little bit, and we certainly have a lot more companies that released earnings this week relative to 2 weeks ago, with that notion being intact. So check out both of these pieces. They do provide tangible, objective information, and as well as other previous pieces in our market commentaries to showcase tactical, and strategic adjustments on the investment platform.